The last time we learned one of the econometric model of volatility called gauge class model, right? And we did some practice using KOSPI, which is our stock index. And the procedure was very simple. From this EViews dialog box, we choose arch. Okay? And then the mean equation is specified. Let's say d log KOSPI. So we are making a continuously compound return. The data is monthly, and perhaps some constant. There may be or maybe not, some autoregressive component there. And default is arch side P is set equal to 1, and gauge side Q is set equal to 1. That's typical one, and usually it works very fine. This one, error distribution, normally, default model is normal distribution, but of course you can pick something like a student T distribution. By allowing a gauge type effect, you are trying to explain the leptokurtic feature of the empirical distribution. Okay? But when you introduce a fat tail distribution like T distribution, then normal, of course, relative to normal, you are trying to explain fat tail distribution of your empirical distribution. Okay? So usually choosing student T distribution, goodness of fit increases dramatically. Okay? So that's usually a preferred specification. So let's see if it works. But the sample is too short, right? So let's set it back to 1993 month. It says start from month 9, right? Here, month 9, right? What is mistyped here? Yeah, it should work. Okay. If you look at this result, basically the mean part appears to be insignificant. Neither this autoregressive component. So probably you can set this one equal to 0. So dropping autoregressive component. Okay, just leaving just constant there. The sign of this intercept time, the variance equation appears to be positive but not significant. Okay. But this is typical the case. We usually don't pay much attention to the significance of this guy. Okay. We need to focus more on these two estimates. First, this one, coefficient to the lagged residual squared residual, that's one. And this one is, the gauge is, in our notation, sigma t squared. Okay. So this one is a coefficient to sigma t minus 1 squared. Okay. So usually, first thing is to check the significance. So this is marginally significant. And then we try to sum this thing and see if it is less than 1. So that's the stationarity condition I mentioned, right? So slightly less than 1, but very close to being 1, right? But when you look at actual plot of this standard deviation, gauge type volatility over a period, it's kind of very smooth, not moving this way, right? Very smooth. The smoothness feature comes from this coefficient much bigger than this one. So because, left-hand side you have sigma t squared, and right-hand side you have sigma t minus 1 squared. So it's autoregressive structure, right? So if this number is big, that means it is very smooth. And if the size of this coefficient is reversed, then usually the sigma t plot will look more like this. Okay, so that's the one. And then because we assumed a t distribution instead of a normal distribution, we are adding one more parameter to be estimated, which is degree of freedom parameter. So 7.6 was the degree of freedom of t distribution, appears to be very significant. Right? If you compare the specification with normal distribution, the previous one, with this one, then this figure, thing called log likelihood, this number is bigger the better. Okay. So this model will produce much bigger log likelihood than normal specification. So that's what I was emphasizing. Because these two appears to be insignificant, so let's get rid of this part first and see what happens. Then, this value slightly increases, right? Right? Because the rest of the parameters are more compactly, more efficiently estimated, so significance slightly increases, right? Okay. So that's one. And if you view Garch graph, conditional standard deviation, this is sigma t, right? So if you recall, because our data is monthly, so this scale corresponds to monthly volatility, measured in terms of monthly frequency. So usually we multiply this figure by square square 12 to make it annualized figure, right? So when we actually did that, this was the annual figure. Let's change the sample. Yeah. This result, sigma t times square root 12, and to make it percent, I multiply that by 100. Okay. So this is annual figure, and so we can see that in KOSPI, our stock exchange kind of long-term average volatility is around 25% a year, compared to like 15%, between 15 to 20% in the United States. So our market is riskier because we are emerging market, right? And time of crisis, like October 97 or November, it's skyrocketed like that, and global crisis again, right? Okay, so this is one version of volatility model. And let's take a look at one important alternative model here. Actually, we'll take a look at a couple of alternative models. One, basically the extension of basic Garch model. And the second, this one, exponential Garch. This E stands for exponential Garch. And name is sort of obvious because instead of modeling variance equation in terms of variance, it used log variance. Okay? So log variance. So when you actually exponentiate this one, then you will get this number, right? So that's named exponential gauge. The autoregressive part, right? And conditional heteroscedastic, well, it's all conditional, and this is not constant, so heteroscedastic. Okay? So conditional and heteroscedastic. Why? Well, the specification up to this point is very similar, actually the same as basic gauge model. What is the difference here? Why do we need this? Well, this model was proposed by a person named Daniel Nelson, and we econometricians believe that he's one of the genius in this area, but he died young. You know, he's too talented, and God loved him very much, so he passed away early. The reason is, well, in a previous gauge specification, we made some constraint on the parameters, like intercept term in the gauge 1.1 specification was assumed to be positive all the time, right? And coefficient to P lag and Q lag, all those parameters are assumed to be greater than or equal to 0, okay? Not being negative, okay? But when you build a model, and if you put those constraints, and actually you are confining the space where this variance can move, right? So the better model is the one with less restriction. Less restriction, okay? So Daniel Nelson wanted to propose a model so that it doesn't need any specific constraint on parameters in this way. See, natural log of something could take on any value, even negative, right? It's okay. But once you exponentiate it and recover this one, it's all positive, right? So you don't have to put any restriction on this one. Okay? Of course, there is a autoregressive component, so we expect that beta is less than 1, right? Less than 1, but that's typically satisfied. And then what is the other feature? Well, here is the one. This one is the kind of highlight of this model. That is, well, in a previous gauge specification, suppose that there was a big negative shock previous period. Then that will increase current variance to the same direction, right? So what I'm saying is, in a gauge specification, if there is a big negative shock, then this is greater than or equal to 0, right? So if it's positive, then it will increase this one. Right? What if there was a big positive shock? Well, big positive shock, again, squared, and it will affect the same way, right? So this model implicitly assumes that people behave the same way regardless of the nature of shock. Whether it's bad news or good news, they respond the same. Only magnitude is important, right? That's the feature because you introduced this squared residual term, right? Squared residual term. But, it is well known, if things are very uncertain and risky, people, pay attention to the news, like who's going to be the next chairman of FRB, who's going to be the next chairman of BOK, the governor of BOK, and so on, right? And we listen to them. But if things are normal, we don't pay too much attention, right? So, historically, there has been a tendency that people tend to respond to the negative shock more than positive shock. And we technically call it leverage effect. Leverage effect. And that kind of phenomenon has been known since by Fisher in 1973 or something. It's a well-known feature. But this Garch model appears to be simple, appears reasonable, but still doesn't capture that leverage effect. So Nelson introduced this one to solve the problem. So this psi t minus 1 is this guy. Okay? So previous shock. Okay? And it doesn't, you don't square it, right? So if omega is non-negative, so suppose it is positive, okay? Then depending upon the sign of this thing, in previous period, it will affect differently, right? If it is positive, if it's negative, then, of course, it will increase that, right? Or if it is positive, then let's see. No, the effect is the size-wise is different. Size-wise different, right? So this one is basically the one capturing leverage effect, and if omega turned out to be non-zero, then we say there is a that kind of effect. So if you take first derivative of this one with respect to that, then actually you can see that this magnitude will be different, okay, depending upon the sign of this one. So this is a leverage effect term. And the second one, this model also look at the magnitude of shock. So what is this number? Square root 2 over pi. Well, square root 2 over pi is the expected value, theoretical expected value of absolute value of standard normal random variable. So this one, this absolute value of this one, it could be big or small, right? But if it is greater than average, then it will affect more. If it is less than average, then the effect will be different, right? So size effect here and leverage effect here. Okay? And you can get this result from, let's take a look at this. If you choose model here, here's a E-Garch, right? So choose it. And let's put it back, the original one. So hopefully you can read this one. This term, this RESID is epsilon. Epsilon. And it says minus 1, so that's t minus 1. This one. And it says square root function and Garch, right? So square root sigma t minus 1 squared. That's what it is. Right? So what is this? Epsilon t was that's the definition, right? So this divided by sigma is this one. So absolute value of this one. Right? So you can read this one, similarly this one and that. Okay. So the representation is slightly different from our lecture note, but the essence is the same. And this is log of this. Okay, then those are parameters and appears to be all significant. We don't have any restriction on the sign of this coefficient, right? Except, well, this is the one, they're close to being 1, but less than 1, right? So if you look at how sigma t looked like, different, right? Different from what we've seen from the gauge specification. Right? So it would be good exercise. You save this series, okay, and that's going to be this one. Actually, in EBUS, you cannot save this sigma t. Actually, you are saving this one. Okay? So, whenever you have that, you can take square root of it, right? So, take this and multiply that and multiply that by 100 and compare this result with the one we computed from Gauge 1 model. Then you can see the difference. Okay? Difference between these two models. I strongly recommend you to do this exercise because, sometimes you may misinterpret this as an output from EBUS as something sigma t, right? Then calculation will be screwed up and the whole magnitude will be different, right? So you have to do it at least once so that you can produce exact number, right? I showed you last time how to save this as a series. Do anyone remember? How do you from view or from estimate? Where was it? Where do you find menu that allow you to save sigma t squared? Probably you all forgot, right? It's right here, proc. And here, make Gauge variance series, right? So it's saving sigma t squared using monthly data, okay? Sigma t squared from using monthly data, so inside is square root sign. So take square root and then multiply these and that, and that will give you the answer. Probably you won't be doing this in a short period of time, so why don't you do it? Okay, and see if, how it works. Okay, the name I gave is Gauge 03. Okay, Gauge 03. And then, okay, here, when you make series, new series, we use command series, right? Series and give it a name. SD, this time, eGauge, any name, okay? Equals to 100 times, what was square root function? Add SQRT, right? SQRT in EBUS. And the one we just saved is name here, Gauge 03, right? So I type 0.03. Of course, you can multiply 12 inside the square root function. Same thing, right? So if you prefer, this way. So we have the version of annualized standard deviation from Garch model and from E-Garch model, both assuming normal distribution, right? Normal distribution. Of course, you can assume t distribution. Let's take a look at the difference here. So these are the difference. Okay. So basically, one of the feature you may or may not see is we know there is a shock, right? Currency crisis. So it rises. Okay? And then if you compare this blue Garch model and E-Garch model, it dissipates much quicker than this one, right? What I mean is, if you believe this model, volatile period lasts longer than this one, right? Because shock to stock market come and dissipates, right? But some people may believe still we are in a high volatile state or very close to being normal, right? So that's the difference. Okay. So whether this kind of difference is important in real life, well, actually, the standard deviation sigma is very important parameter when you try to calculate the value of option. Value of option. So what is value of option? Well, you can think of Black-Scholes formula. One of the input is sigma, annualized sigma. Okay, and that's well, if option expires sometime in the future, like at this point in time, what you need is you have to make a guess about what is the average volatility between these periods, today and the date of expiration. Okay, so here it happened to be very similar, right? So forecast could be very similar, like this way perhaps, right? If this is the average, slightly below average, right? So could be like going like that, okay? So in that case, very, very similar. But if you are here, and if your option ends mature here, then your forecast could be very different, right? Very different. So the price you are thinking as a rational price could be very different depending upon your model, right? This arch model, actually, starting from actually not Garch, arch model was invented to model UK inflation rate. So first application of this type of model was to model UK inflation rate by Robert Engel in 1982 or something. And since then, much less application in economics, instead many applications in finance. Because all those financial time series appears to be heteroscedastic and the volatility is conditionally time varying over time. Okay. The last model I want to show you is something known as GJR model. Named after three researchers in this area. Or we call it threshold arch or Garch 1-1 with the leverage effect. Okay. So basically, if you look at the variance equation, the same structure up to here, except this one. Okay? So previously, one of the shortcomings of standard GARCH-1 model was if there is a negative shock, this is squared. Okay, so it doesn't distinguish whether it was negative shock or positive shock, right? So how to distinguish that? Well, you introduce dummy variable. So dt minus 1 will be 1 if previous shock was negative. Okay? Otherwise 0. So if previously if shock was negative, then this becomes 1, and this is the same thing. And if this is non-zero coefficient, then the effect will be not alpha 1, but alpha 1 plus lambda 1. Okay? If previous shock was positive, then this number, indicator variable d, is 0, so it drops out, so only this one. Right? So in this case, threshold is whether it is 0, less than 0, or greater than or equal to 0. So 0 is a threshold, right? But in some other application, threshold could be some different number other than 0, right? So you can set that threshold at your discretion. So that's the general threshold arch model. But the GJR model threshold is simply 0, whether it's negative shock or positive shock. Of course, you can actually, there could be many other factors that might affect current volatility, right? So suppose you have a value or a variable known at t. So suppose you believe that if transaction previous period is important in the determination of current volatility, then you can use previous volumes of trade as one of the regressor from this side. So if we have some exogenous variable x known at t, then you can add here that variable. Okay. Sometimes you may think that volatility moves here before currency crisis, 1997 currency crisis, and then after. So maybe there may be some kind of shift, right? Then you can create dummy, take on value 0 and 1s, and use that as a regressor here. Okay. So if you add that 0, 1 dummy, then that value will be, if period is the second subsample, then the coefficient will be added to this one. So making baseline volatility higher, right? So you can extend this simple specification to more reasonable or alternative model. And you can do that here. You define those dummy variable in a walk file and then list up here. Okay. Then you can extend your variance equation. And also here, you can you can introduce, let's say, if I press standard deviation, then you are calculating, let's say, sigma t from here, sigma t or sigma t squared, right? Variance equation. Now, you can set up the model where a sigma t calculated here may affect return, mean equation. Okay? By selecting arch in mean equation, you can use current sigma t as explanatory variable, or sigma t squared, or log variance. Okay, so let's put this one and see what happens. This is eGarch specification. See, Garch and square root of it is included. Coefficient is usually expected to be positive, so more volatile than you expect that expected return should rise, right? But in this case, not significant. So no eGarch in mean effect, right? But you can try that. Okay, that's about. Read through this lecture material. I showed here. Try arch and specify 1, 1, and Gaussian and mean equation, and then you get some result like this one, right? And this is the way we calculate. Instead of Garch 03, I gave the name 6 squared. Right? And then you can calculate annualized version, but it's expressed in decimal. So if you multiply that by 100, you can make it percent, right? And to compute forecast, you can give a name for forecast of series name. Okay, so this is in terms of level, and this is in terms of variance equation. Okay, and out of sample has to be specified, otherwise, you calculate everything. And this screen may be slightly different depending upon the version. I have version 7.1, and probably you're working from FitLab version 8, I guess. Anyone remember? Or was a version 7? Still 7? Okay. We usually update this site license every year, so you'll see next time version 8. So this is Garch forecast. So at the end of the period, this was the last observation, and it appears that for this particular data set, total return, continuously compound total return, United States, that was about average, so it's moving forward like that, okay? Compared to historical volatility, whatever it is computed and is ended here. So there's a difference, right? So if you have calculated historical volatility instead of Garch variance, your forecast is, well, you can't simply put a line like that, right? Because it's not a model. So your best forecast is simply flat line here. Right? So that's why we seek for econometric model instead of historical volatility or exponentially weighted moving average standard deviation. And we also talked about baseline volatility, how to calculate it. And if we have that, and this goes to numerator, and 1 minus sum of these two goes to denominator. Okay. So if you calculated that, and in this particular sample, this is the line. Okay. So because here you are slightly below this long-term average line, so it's moving slowly upward, right? And then it eventually converge. So you get the feel, right? So you can do this exercise using interest rate, using exchange rate. Okay, when I specify mean equation, I set up command like d log cos p, right, to make it continuously compounded return. Suppose you're working with exchange rate. You can do the same thing. D log exchange rate, same thing. Okay? But if you're working with interest rate is already expressed in percent, right? So you don't usually say D log and the name of interest rate series. Instead, D name of interest rate series. So interest rate, exchange rate, stock index, all those are non-stationary time series. So you have to convert it to something stationary. So one way is to take log difference to make it continuously compound return, or proxy of return, rate of change. But because interest rate is already non-stationary, but expressed in percent, you just take simple difference, and rest of the procedure is the same. Okay. So now we'll move to multivariate extension of this simple Garch or other type model. But before we move to the multivariate framework, any questions? Probably we'll cover up to this volatility model, and that's usually the coverage of midterm. Okay, so and midterm is scheduled next Thursday, right? Next Thursday, 2:30 here. I believe it's the 17th. 17th is next Thursday, right? Yeah. Okay. Can I move on? All right. Now, when you have more than one series, now you are looking at not the univariate time series, this time multivariate time series. Okay. So you are adding, let's say, this multivariate Garch. Well, it appears to be very simple, but you are in big trouble because it's heavy stuff in terms of finding converging estimate of the model. And you will see the reason why shortly. So let's take a look at this simple example. Suppose you have more than one series. So a stock return of Samsung Electronics and Hyundai Motors, HMC. Okay, so you have two variables, right? Two return series in a vector, and so this has to be vector, right? Two error terms, and mean is suppressed here. Conditionally multivariate normal, and mean vector is 0, right? So 0, 0. And then here, this is problem. Now it's varying over time conditionally, but now this is not a scalar variable. This is matrix. Right? So if we have two variables here, and this is going to be 2 by 2, 2 by 2. Okay, so 2 by 2, right? So first variable, second variable. This is, in our notation, previous notation, this is sigma t squared. Sigma t squared. Then what are those? Covariances, right? And we all know that the covariance, they are symmetric, right? So what we need is we need to specify this guy, then either this or that, right? Well, so basic strategy, when we say, let's say, two variable case, the multivariate Garch extension, well, in somehow you can model this one as using this name, Garch specification. Following Garch specification, and Garch specification. It's okay, right? Appears to be, they're complicated. But the thing is, we all know that the variance is positive, right? Variance is positive, right? Suppose you have matrix, have numbers, variance, and covariances. Then somehow you need to impose this condition, right? So you want to make it this way, right? But we don't say it this way. What is proper term for that? Positive definiteness. So, what we learn from matrix algebra or linear algebra, we talk about this one often. So we check first, we calculate determinant of this matrix and see whether the determinant is 0. If it is 0, then we say it is singular, okay, not positive definite. Okay, so that kind of thing. But the thing is, this condition has to be met. Okay, so if you simply put any number, sometimes you may be lucky to satisfy this condition. Okay, but usually, more likely that you fail. Is that me? Yeah, today is meeting day to me. Meeting after meeting after meeting. I have 2 more meetings and then I call it a day. Okay. I'm glad to be in class instead of attending those boring meetings. Okay. So now the problem, you may capture the problem. If you let these guys vary following Garch specification, because it has time subscript t, right? It'll go. Okay. At some point in t, if the combination doesn't seem right, then you violate this one. Then what's the problem? Well, when I didn't go through the way we implement maximum likelihood estimation for the model like Garch or eGarch, but I emphasize that those models has to be estimated using maximum likelihood estimation, and that was the reason why I introduced Gaussian distribution or T distribution, right? So in this case, this is a multivariate case, so you have multivariate normal distribution. Okay, and then later we try to calculate for each t dense function of this one, and try to calculate natural log of that to later sum it over from t equals 1 through cap t and try to maximize that number. That's basically maximum likelihood estimation, okay, given parameter initial guess. But if this is not positive definite, then you can't calculate this density. So their problem fails. And if you have no constraint, then you can't prevent those Garch process for this thing violates the condition, right? So extending Garch to bivariate or trivariate or multivariate model, idea is simple, but practically you will face a lot of problem of finding converging estimate, and even if you extend it to from a 2-variable case to a 3-variable case, probably you will need a lot of luck. Accidentally, you may find converging estimate, but that threshold is very thin, very thin. Here is one version. So, well, this part we don't have any parameters to be estimated, but here you are specifying this one as a gauge. So if you specify this one and define H at T, then you can evaluate this multivariate normal distribution, right? So specifying HT is important. And here I just introduce you the name only, back-H model. Back-H model is like, if you have numbers like this one, then you are, because it's symmetric, right? Symmetric. So looking at this triangular part and creating vector from this matrix, and the order is this, that, vector. So if you have 3x3 matrix, then 1, 2, 3, 4, 5, 6. That's back-H function in mathematics. Okay? So the name back-H. So these are 3 things we need to specify, right? So I mentioned that we model this one as a gauge. So the first variable, gauge process, this is constant term plus, and then this times that. Sorry. This is vector. So let's see. Okay, there could be some, well, let's say these are 0, then this times that, and also if this is 0, this times that, right? So that's first gauge, right? And here, similarly, if these are 0, then the gauge, right? And then covariance is constant plus, let's say, coefficient time, now cross product, not squared, right? Here, 1, 2. Okay. So setting it this way is what we call as back-H, but unfortunately, it may not work, right? They violate the positive definite condition. So let's forget about this part. Just seeing is enough. There is a version of multivariate model known as back-H. Okay. Instead, what we'll see is something called BKK model. Those are the initials of co-authors who invented this model. So write it this way, and looks a little complicated, but the idea is very simple. 2 by 2, right? So you have 2 by 2, has to match dimension, right? And here is 2 by 2. So we have everything here, right? We need here 2 by 2, right? And then here pre and post multiplied some constants, right? And also pre and post multiplied. Okay. So in a compact notation, this is HT 2 by 2. Could be modeled in this way. And hopefully, regardless of combination here, A's, B's, hopefully these satisfy definite condition. Okay. But even this specification doesn't work that way. So here is the final one. Restricted version of BKK, and is often used in application. Put some restriction on this and that and that. Okay. Simplifying assumption is this one is assumed to be, a lower triangular matrix, diagonal matrix, and diagonal matrix. If you specify a Gauss model for first variable, you need at least 3 parameters to be estimated, right? And the second variable, 3 parameters to be estimated, Gauss 1 model, right? Also, the covariance process, you have 3 parameters to be estimated. Total 9 parameters to be estimated, right? But if you specify in this way, how many parameters to be estimated? 1, 2, 3, 4, 5, 6, 7. You reduce it to by 2 parameters, right? But this one will make you happy. That one will be positive definite. And that's what they showed. Okay. So actually, if you work out this one and write it in terms of equations, okay, this is basically how does it look like. Okay. So you see, this is basically first variable, exactly Gauss specification, right? So parameter, parameter, and parameter. Right? The second one, intercept term, parameter, and parameter. The covariance equation, this is intercept term, coefficient, coefficient. Okay. So we are focusing on the same example, large capital stock and long-term government bond in terms of return and its monthly data. So you have 2 variables, right? 2 variables, so bivariate case, and you want to estimate those. And also covariance divided by square root of this and square root of that, that's correlation, right? Correlation. But there are time varying, so correlation is going to be also time varying, right? Okay. Here is the result. These are not annualized, so numbers are different. But using monthly data, this is a variance. So this is a plot of sigma squared, sigma t squared. Okay, sigma t squared. This is the variance, Gauss variance, according to BKK. And second one, this red line, that's the volatility of bond market. And this green one, this is the covariance. So we expect that bond market is less risky than a stock market, so has to be there, right? So if you calculate correlation, time-varying correlation, and this blue is the one from BKK model, and this is the counterpart, the red one is a historical correlation we learned at the beginning, right? So model-based time-varying correlation and the simple calculation, well, sometimes match and sometimes very different, right? Particularly, during the period when there is a shock. And you can easily see that, this one is from historical correlation, and we all know that if there is a big shock like this one, historical volatility or correlation, effect of that big shock will last up to some moving horizon, right? Moving window. So there is like box effect, right? And then the effect of this shock disappears after 36 period, and then, go back. And actually, if you try to allocate your fund to stock or bond, and simple Markovit's mean variance principle says correlation is a very important parameter to determine the investment proportion to stocks and bonds, right? And often we assume that correlation is constant like this, but in fact, there's evidence that sometimes they're small and big. Right? And of course, if you call stock as a one asset class and bond as another asset class, then hopefully the correlation between two could be small. The smaller the better. When you try to diversify your investment. Okay. Just in passing, you should try this one, very delicious. Where is it, my essay class? Do you know who this is? Anyone who recognize him? He is the chairman and CEO of Mirror Asset Financial Group. That's one of the leading security companies as well as asset management company. Actually, this room was in part donated by Mirror Asset security companies. So name, there you can see the plate in front of this classroom. Anyway, he's the one who built his empire, and he said he's allocating about 15% of all the investment companies making to a thing called AI, alternative investment. Alternative investment, it includes real estate, buildings, those. Not the financial products, it's physical products. So buildings in Pudong, Shanghai, China, the big building, they say they are allocating about 15%, and actually the one, the country club you've seen in the previous picture, that's owned by this company, and that's one of their diversification strategy. And the reason behind that is the correlation between this the return on alternative investment or alternative asset is quite, correlation is quite low to others like stocks or bonds or like those. So we'll skip this part. It's been very important. Well, it has some, all those models like constant correlation model. Well, correlation, if model works, correlation could be varying, and you can estimate it, right? So that's better, right? But if you have, let's say, 7 variables or 10 variables in one problem, and if you can't calculate those parameters, then how will you do it? Well, you have to sacrifice something, right? So you may build, let's say, 7 variable model, but volatility could change, but correlation is assumed to be constant. Pairwise correlation is constant. So that's more restricted version, right? So in some application, it may be meaningful. In some other application, it may not. So just knowing the name is sufficient. And the factor model, well, we'll see something similar to this one. Basically, when we say factor model, this is the one, very powerful time series model, where, let's say you have as many variables on the left-hand side, so many variables. So, dimension is very big. But if you try to introduce conditional heteroscedasticity to those, large dimensional problem, we know that number of parameters to be estimated increases dramatically, right? So it's beyond your, control. So what you do is you are thinking about reducing the dimension of the problem. Okay. So the basic idea is very simple and very interesting. Think about why components in this vector RT changes. Why they vary over time? Well, we are thinking the source of that variation from 2. First, something common. So if this is, let's say, 10 variables, okay, so this one is one series. So common series. Okay? And then this is what we call idiosyncratic variation. So residual vector. Okay? So think of this way. Why, suppose first variable is return on Samsung Electronics, okay, stock. Why Samsung varies? Well, if you think of this one as a Kospi, because market varies, so this beta is some vector of coefficient. So if market varies, Samsung varies. Okay? If merits, market varies and different number and affect merits. Okay? Samsung has very different structure than other company, so their own variation is added. Merits, they have different added, right? So, in this way, of course, usually this is unknown variable. But in time series analysis, we have clever way of actually estimating this parameter beta and as well as tracing out this scalar unknown variable f of t. So we call that as a factor model, and we'll take a look at this type of model when we discuss Kalman filter later on, state space model. Okay? Well, suppose you are seeing some conditional heteroscedasticity going on in a vector of stock return. Where does that conditional heteroscedasticity comes from? Well, it may be coming from here. Right? So if you can treat this f of t as just single, although unobserved, some sequence, and then you can specify this one to follow gauge process. And then proportionally affect that. and then their own noise is added. Right? So you don't have to introduce, let's say, 10 gauge specification and covariance terms. You are just modeling this one. It's one variable with 3 parameters following gauge, but having very similar effect. Okay. Sometimes that may work, and sometimes it may not work that well, but that's one way of modeling it. And actually, this type of model has been introduced in many areas like business cycle modeling or exchange rate modeling. And this particular one, I borrowed it from international finance literature, where you have many exchange rates, okay? Of course, in terms of change, percentage change. Why exchange rate varies? Well, we think of there is a common source, something unknown, okay? And then proportional. And some currency is affected more than other currencies, depending upon the scale of this one, right? These parameters. But what is f of t? Well, I said that's unobserved. That's in your imagination. But something that creates the variation to all those component variables. Well, one of the interpretation in that kind of international finance application was, well, f of t is sort of proxy for the news to dollar market. Every currency, usually when we compare currencies, we have, let's say, Korean won divided by US dollar, right? We say US dollar denominated, right? So yen, dollar, yen, dollar, right? So dollar is occupying all those denominator, right? So if there is a news to dollar market, then it should affect, right, others. So econometrically we estimate this one, but when we actually estimate and try to interpret it, and you may conclude that, well, that's actually the news to the proxying US dollar market. So good econometrician, and if you to be a good researcher, there are many tools like that one and applying to various problems. But when you end up with some good interpretation of your result, and then you will be recognized. That's what PhD is doing. Tools are all known, more or less, but the interpreting the result correctly, that's more important than being technically sound or something like that. Okay. So read off the rest of the part, and shouldn't be that difficult. So let me jump. Okay. Of course, whether you specify a model in this way, very simple, Gaussian process. Later on, your final destination is what is the conditional volatility of each component series, right? But what it says is you can compute those covariances, time-varying covariances and variances using this formula. And these are parameters, hopefully you can estimate. And because you specify this one, so here betas are coefficient of this matrix, vector, okay? So if you estimate those parameters along with covariance here, then you can recursively generate forecast right here using that. So if you generate the forecast, then multiply appropriate numbers, then you will get this number as a forecast, right? So that's what it says. You can calculate recursively. Okay? This is my favorite, and actually it's being used in some of the company these days. Well, we call it single index model. The idea is very similar to factor model, but this is much simpler to implement. Say, yeah, I try to spend 5 more minutes. This is 45, so okay. So first step is, this is market return. So you have, let's say you have monthly data and monthly Kospi index, and calculate this one as log difference of Kospi, okay, index. And this is Samsung, return on Samsung stocks, okay. So stock return here, stock market return here. Just simple regression and get this one, right? So if we have different companies and switch it and calculate different numbers, right? So you will see probably, some company will have beta I greater than 1, something similar to 1, something less than 1, right? So if it is much greater than 1, that means if market change, it will respond more, right? So small stocks usually belong to that class. If market moves this much, they move much more, right? So riskier, right? Smaller stocks. So you capture those features from this one, okay? And then, what is the variance? Well, this is a random variable, and it has a variance. So the variance of this one, this is constant, so it doesn't vary, right? So variance of this one is simply, variance of this is squared, and the variance of that, and no covariance is usually assumed. So no covariance, and then the variance, right? So variance is simple, and also you can calculate, if you do some algebra, a little, then you can calculate, you can write this one in terms of subscript J and calculate covariance between R sub I and R sub J. And usually covariance term, this term drops out. And why they co-move? Well, it has same thing in common here, right? This is idiosyncratic variation. So this shouldn't affect, and this has something to do with it, right? And it turns out the covariance is simply the variance, not this time something squared, this time cross product. So if you run OLS, you can calculate, estimate this, and this one, right? So if you have a data, of course you can calculate this, right? So you can easily calculate this number and that number. That's basically single index model. So index model means this is index, in this case market index, right? You can have more than one index. Let's say 2 index model. Well, you can divide Kospi into large stock or small stock, right? Or large stock, small stock, value stock, growth stock. So 4 possibility. And if you have 4 index for those 4 classification, here is 1 index, 2nd index, 3rd index, 4th index. Instead, if you are looking at industry, let's say 22 industries, and 22 industries could be entered, right? So here, the example is a single index model. And now, you can calculate, suppose there are n stock returns, so n by n. Your task is to fill out all of this, right? So how many parameters to fill in? N times n plus 1 divided by 2, which is a huge number, right? But mechanically, all you need is, sigma m squared are common. This is common. All those betas are easily computed from least square. So betas are easily calculated. And variance of residual term in a simple regression is easily computed. So in matrix term, this way or in this way, but quickly you can fill this in. Okay? Well, if you want to predict future value of this one, then you can give it a dynamics. You can make this one, well, this is constant variance, market variance, right? But we know that cost P volatility appears to be varying over time as well, right? So you can specify this one as gauge volatility. So replace it, then you have different numbers, right? So if you plug in gauge forecast, then forecast value. Right? If you plug in here EWMA volatility for market variance, then EWMA version of this one. Okay, so this is the case where I did some work with my graduate students the other day, using monthly data, using cost P return, gauge 1-1 normal model is estimated, something like this one. Okay, so this one is going to be replacing this. Okay. And this side, I have 22 return series from 22 industries in Korean stock market. So 22 industry, and you can estimate beta sigma squared, right? So, if you calculate those beta over time, using some moving window, let's say 60 months, particular industry. So we try to see if whether beta 1 coefficient for this industry, or that industry are changing over time. Okay. So some industry change a lot. Some industry seems to be very stable, right? So betas are those numbers. So at this point in time, you have all those beta, right? And this is the gauge volatility using cost P. And this one is compared to EWMA volatility, and we know that there's a box effect, right? Box effect. But we use this one. And so as of October 2007, volatilities of 22 industries, so this is annualized, food and beverage and those industries. See, historical volatility, EWMA with a moving window 60 months, lambda is set equal to 0.97, and single index plus gauge specification instead of gauge EWMA, right? So 4 different versions, and this is our default model in this case, today's lecture. So these are the numbers. Very similar, right? Similar, very similar. But at some point, could be different. Yeah. So in practical applications, users can have combo box so that they can choose, well, I want to define my volatility measure as single index model, or EWMA or this one. So, but industry-wise, the difference appears to be not that big, right? So those volatility and the covariance matrix, we're using that, those industries. This is Markovit's efficient frontier. And when you draw this efficient frontier, those covariance matrix, of course, expected return, I didn't show it here, but expected return and those covariance matrix is very important when you derive this kind of one. So they use it. Some method, EWMA or others. Yeah. Right? But this software itself is developed by our graduate students, master students. Okay, let me, well, that's all I have to say for today. Questions? Anyone who forgot to bring your homework? Okay. Then, thank you for your attention. And then, Monday next week, I'll try to go over previous questions, exams, last year's, and see if you have any questions. Or, there are many ways of answering the question to the midterm, but you get to the point and you can write it, as short as possible. As long as you get the message, I get the message, then you have the full credit. But if you leave it blank, then there's no way I can help you, right? So practice exam is a practice exam. Don't expect this exam is going to be the same as that, right? Fairly significant portion could be very similar. I could twist a little bit, twist and turn and a little bit, but essence, I try to have something in common, like our index model, okay, covariation, and then some idiosyncratic, surprises. That's all about. But try to write your answers in English. If you're from foreign country, then you may be accustomed to it. But Korean students, if you don't practice it, then it's going to be very difficult. Okay, so practice it, and let's see what happens on Monday. Okay, and exam is going to be on Thursday. Thank you very much. Have a good weekend.